myself Aditya P. Tripathi, and we are here to continue our discussion on the topic of financial analytics. This is going to be part 3 of our lectures on analytics in finance, and in the previous 2 lectures of mine I tried to give you a brief introduction of what we do into analytics, what is there into analytics for us, and why we are shifting from analysis to analytics. So we shall be extending our discussion on the same topic in the same direction. So with that, the agenda of today's lecture is financial analysis versus analytics. I'll be telling you about the objectives of financial analytics, then what are the common inquiries in analytics, what we expect from this domain of knowledge in the field of analytics when it comes to financial analytics, what are the common inquiries which we are expecting as a company, and of course the different tools and techniques which we are going to use in analytics. That will be our focus of discussion. So with this agenda, I'll be first telling you about what we do into financial analysis, because we all are from the same background. We belong to the fraternity of accounting and finance, and we know that what we are doing into financial analysis, we are using different tools. When it comes to financial analysis, the most commonly used tool which comes to our mind is the ratio analysis. That, sir, while analyzing any financial statement, what we do is we basically conduct ratio analysis, or it can be a different kind of analysis where we go for having vertical analysis or horizontal analysis or multi-dimensional analysis, whatever is the nature. But in one way or the other, we are going to find some ratio, we are going to find some relationship between the two components. Some may belong to balance sheet, some may belong to income statement, and there can be a cross-sectional study also where we are having mixed ratio also, because one component is from balance sheet, another is from income statement, that is profit and loss account. So the ratio analysis is basically the most commonly used. Apart from that, we have the statement of cash flow analysis and all. So I'll first be telling you what we do into financial analysis and how it differs when we are shifting our course of analysis, our point of analysis, our perspective of analysis from analysis to analytics. So in financial analysis, basically we refer to ratios which are used to analyze the financial statements, and very popularly we have 3 different heads for ratio analysis. One is solvency, another is activity, and third one is profitability. So we are increasingly interested in knowing what is the solvency position of a company, whether company is able to meet out its short-term and long-term obligations or not. If a company is able to make payment of its obligations, its liabilities, then of course we'll say that company is solvent. And when we talk about activity, we look at the turnover ratios. All turnover ratios, they are telling us about the efficiency and effectiveness of the company. And that is why we say the higher the turnover ratio, greater the efficiency and better the profitability. So solvency, activity and profitability, these are 3 broad heads of ratio analysis where we have been using different types of ratios belonging to balance sheet, income statement, or at times the mixed components from both the statements. But our focus have been to find out whether company is solvent or not, whether company is active or not, to what extent it is active, and if it is active, what our turnover ratios are speaking, what is the position of our profitability. When we talk about profitability, we have 2 broad sub parameters. One is based on sales, another is based on our capital employed. So when we calculate gross profit ratio, net profit ratio, it is based on sales, whereas when we are computing ROI, that is return on investment, or ROE, return on equity, then it is basically based on capital employed. So our focus have been to find out the solvency position of our company, our activity position and the profitability position, and that have been the motive. But just do remember, while doing this kind of analysis, we were focusing, we were finding all inputs from where? From our income statement or balance sheet. So everything was originating from the balance sheet. So whatever company has reported in terms of income statement, profit and loss account, or what you call as statement of profit and loss, and the balance sheet, we were taking inputs from there, and then we were finding ratios. So it was a kind of post-mortem. Whatever has happened in the last financial year, we are trying to find out the ratio between and among all the components, and then reporting that, see, this is the solvency position of the company, this is the activity position of the company, and this is the profitability position of the company. So in that process, we were not at all doing anything new. We were simply basing our discussion, our analysis on data which is provided by the income statement and profit and loss account. But a very obvious question comes to our mind, sir, what if that data itself is not reliable. What about the reliability of the data? What if the data which we are having is not giving us the true picture, showing us the true and fair picture of the company? And here comes the role of financial analytics. It includes analysis on operational or commercial data. Financial analytics is different from analysis in a very broad terms. It is basically it differs on one parameter, and that is called, we are not using the financial statement only, we are not using balance sheet only, we are basically basing our discussion or analysis on operational or commercial data. So we are talking about the operations of the company. And of course, in our journey from financial analysis to analytics, basically what we do in financial analysis, we were conducting ratio comparison between multiple companies, whereas financial analytics consists of operational analysis. So what are the steps into financial analytics? What we do is, first of all, we do the operational analysis. What is the situation of the operations of the company? What is the operational performance of the company? And then how this operational analysis feeds into the statements, how it is going to find a reflection into the financial statement. That is something which matters. So we are first, suppose if we are reporting gross profit and net profit in the balance sheet, in analytics, while conducting the financial analytics or looking at the data pattern in the balance sheet, when we conduct operational analysis, we look at the operating expenses ratio. We try to find out what is the composition, what is the share or proportion of operational expenses into this company's activities. So we conduct operational analysis, and then we observe the reflection of this operational analysis into the statement, and eventually we are comparing the ratios. So unlike financial analysis, where we were assuming that the data is provided by the balance sheet or profit and loss account, based on that given data we were calculating certain ratios, we are having formula, we were putting the value and getting the answer, and of course the interpretation. Here what we are doing, our point of origin is not from the balance sheet or income statement. Our point of origin is much before, well ahead of that statement. We enter into the operations of the company, we conduct operational analysis, and then try to observe the way it is reflecting into the income statement or balance sheet, and eventually we have to compare the ratios. So my dear learners, the basic difference between analysis and analytics is that analytics is not leaving any point. It is not leaving any stone unturned when it comes to find out the meaningful insight from the data. And if you ask me, I would say analytics is giving opportunity to the data to speak. So we are letting data speak to us, we are letting data interact with us. That is what is the motive of analytics. You must be thinking that in analysis also data is giving us a meaningful insight. Of course it is giving, but it is based on the data which is provided by or reported by the accounting department, or what you call as chartered accountants. Whereas in case of analytics, we are observing the data from the very beginning, from the point of origin till destination, that what is happening with that data, what is happening with those operational expenses. And if I say my gross profit ratio was 40% and net profit ratio is 5%, then of course we can find out the difference, that where 35% has gone. That we were getting from analysis, that 35% have gone into this operational expenses. But it is after everything is done. We are doing this kind of analysis after the profit of 5% on sales is reported by the company. Now we cannot change it. We can plan for the future, but what about the past expenses which we have incurred? We cannot take them back. Whereas in case of analytics, since we are conducting operational analysis on real-time basis, we always stand an opportunity. We always have an opportunity to take corrective steps. Well in time, well in advance, you can take corrective steps, so that you should not repent, you should not have remorse over the increasing size of this operational expenses, and then you say that in next year or henceforth we will stop spending on these expenses. That is fine, but what about what has happened in the previous year? And we had an opportunity to stop it, but we could not stop our loss. So here comes the role or significance of analytics, and this is what is this is for what we have financial analytics. So in ratio analysis, basically what we do is the top management or middle management is going to conduct this kind of exercise, and it is known as an exercise by management accountants, and it is usually what people refer to whenever they use the term financial analysis. If you ask anybody what is financial analysis, the first and the very obvious answer comes to us is, sir, we are conducting ratio analysis. So financial analysis is somehow limited to a greater extent, it is limited to ratio analysis only. Other tools can also be there, but increasingly people will say that it is basically ratio analysis. So, but remember that ratio analysis is just a tip of the iceberg. It is basically a very smallest part of the analysis which we are conducting in case of analytics. If you ask me about financial analytics, I would say it looks at the complete picture, starting from the operations and reaching all the way through ratio analysis. So analytics is starting from the point of origin and reaching to you till ratio analysis. But when we talk about financial analytics, I have been using the word operational analysis time and again. And nowadays, when we conduct sentiment analysis, we always look for the words. We create a word cloud, and we try to find out the number of times a word is repeated, number of times a word has found place in a particular document, and that speaks the significance of that specific word. Likewise, in case of analytics, we have the greater frequency of the term operational analysis. So that is why it is needed for us to understand what is operational analysis. If you ask me operational analysis in finance, I would say it is basically a process of breaking down the way a company uses its assets and operations. So in your entire operational exercise, in your business operations, the way you are breaking down the way you are using your assets in your operations, that is what we have to analyze. And just do remember that every analyst may have his or her own way to conduct this analysis. So there is no stereotyped kind of method where you would say that the person will go for understanding the asset liability composition only. It is completely dependent upon the analyst, the person who is conducting that analysis, and it depends upon the industry and business model, the kind of business model you have, the kind of challenges you have, because every business is having a unique experience in the market. Not only the business, if you ask about the same business, depending upon the different geographical locations, the challenges are different. If you ask a businessman from the same industry who is operating in Delhi and another who is operating in Uttarakhand, of course they are going to have a different kind of challenges which they are facing. So we cannot have the same analytical tool, we cannot apply the same analytics for that company which is which is having its operations in Delhi and the one which is having its operations in Uttarakhand. So you will have to change your perspective because their challenges are different. So the question comes, what is the objectives or what is the significance of analytics? Basically, it is this analytics aims to shape business strategy through accurate factual insight rather than intuition. Now this is very important for us to understand for what we have analytics. Analytics says that we need a quantified logical answer for any statement we are passing or any decision, any strategy we are formulating. If you have a business strategy and you say that, see, this is the change which I expect, which I want to implement into my business operations, analytics will not accept it unless you have accurate and factual insight about that particular strategy rather than simply relying on your intuitions. You say that I feel like, my heart says, so there is no place for your emotions, for your feelings into analytics unless it is supported by. We can honor your emotions and feelings as a person from analytics background, but of course what we need increasingly is that whatever data, whatever strategy you are proposing, it should have a factual insight rather than intuition. Nowadays you must be looking at all the startups, they are applying for the funding, and this is a challenge which they are facing. When they are pitching their business idea, what is needed? We need basically the accurate and factual insight. What is your business plan? What is your revenue model? Why should I invest into your company? This is what a funding agency is looking for. So they don't believe into your intuition. They are not going to invest into your intuitions. They are supposed to invest into a strategy, into a plan which is factual, which is based on the facts and figures, and you are accurately reporting. And this is what analytics does. If you go for applying this analytics into your business operations, it is giving you, it gives you the meaningful insights based on factual accuracy and factual figures and data. It is not only doing that, but it also offers tools to gain a deep understanding of key trends. You can identify the trends, the pattern which you are witnessing as a business enterprise on real-time basis. Now, my dear learners, this is very important for us, because we can get trend, we can draw a trend line after the time has gone. But what is the outcome of that trend line which you have drawn? What is the use of that data? You are reporting that based on the data, since last 10 years my sales has declined. A particular product is not performing well. What is the use of that? It could have been more useful or meaningful if you could have reported a year before that, see, in 2021 I am reporting that in 2022 and 23 this is going to be the sales figure. But remember, when you are giving this data, it has to be supported by factual insight. It has to be supported by the accurate information. That accuracy percentage cannot be 100%. It can be 80%, 90%, or whatever percentage you identify. But yes, of course, it should hold true. So this is what analytics does, and it enables firms to take corrective actions for improving their performance by providing detailed views of their financial data. So what I am willing to explain here is that the very objective, the very significance, the very motive of financial analytics is to find the information, to get the insight well in time. So if in one line you ask me, I would say that analytics is providing us the data on in a time frame manner, or you can say we are going to take informed decision, that too well in time, because time is always significant. If you take a very good decision but at the wrong time, it is not going to give you the meaningful results. So we have to take decision on time. And if you are taking decision on time, of course you will reach your customers on time, and if you reach on time, of course your business is going to flourish. So as a subset of business intelligence and enterprise performance management, I would say that analytics is basically working very nicely for the success of business enterprise, and it is affecting every aspect of a business and is very critical in assisting companies in forecasting and planning for the future. Now, there are certain common inquiries in operational analysis. When we are conducting operational analysis, we have certain common inquiries that I am going to tell you. First and the foremost inquiry is, what is the profitability of that specific unit about which we are talking? It can be a product, it can be a segment, it can be a specific segment of your business, a specific company under your operations, or a particular unit about which we are discussing. Then they talk about operational expenses structure, what is the structure of operating expenses, what is the working capital management, the way you are doing the working capital management. These are three common questions which we have in our operational analysis whenever we are conducting this. These are three questions. I'll be telling you one by one what we expect in unit profitability, what is our inquiry when we talk about operating expenses structure, and of course eventually at working capital management. So when we talk about unit profitability through analytics, our motive is to take insights of gross profit, operating expenses, profit per unit, total volume, and more significantly cost volume profit. If I am increasing the volume of my product, what will be the impact on two important aspects? One is cost, another is profit. If my cost is decreasing and profit increasing, then of course it is going to be a successful plan for me, and this is something which is going to which forces me, which gives me a logic to invest into this specific unit. So profitability of unit is very important. Now you must be thinking, or you must be feeling little uncomfortable with this, that sir, we have been doing this into financial analysis also, but why are we doing what we are doing in this unit profitability in terms of analytics? How it is different? The difference is, earlier we were looking at gross profit after the sales is reported at the end of the financial year. We were taking a note of all expenses, finding our sales and reporting gross profit. But now what we are doing, the moment one unit is being sold out, commensurate to that or proportional to that, whatever is your operating expenses, whatever is your profit per unit, whatever is the addition to total profit, it is being reported on real time basis. So I have a complete information that, see, if one unit is being sold, till date my gross profit is moving in this direction, my operating expenses are going in this direction, my profit per unit is having this kind of scenario, my total profit is affected by to this extent, and of course this is the impact of the increase in volume. So well in time we can revise the target to the marketing department, we can revise the target to manufacturing department, that see, this is what we have to achieve, we are supposed to achieve this much of gross profit in this financial year, and given this record we are not going to achieve it. So what is important, what is different here is the timely information, and I would say on real time basis we are getting insights about these parameters which are having a reflection of unit profitability, and this is basically possible because of only one point, and that is called analytics. Now if we talk about operating expenses structure, of course we can find pattern and ratio of expenditure, we can find gross profit net profit difference, and what are the reasons for that, why my gross profit is 40% and my net profit is 5%. With this assertion, with this assumption we started our discussion today. So my gross profit was 40%, my net profit is 5% on sales. Where that 35% has gone? Who has taken it out? Whether it is due to genuine reason, or our office expenses are very high. So we need to have a check, we need to control, we need to exercise some control over the non-operating expenses, because gross profit or indirect expenses. So it means the proportion of indirect expenses is very high. And if we are able to somehow reduce or control these operating expenses well in time, at the end of the financial year, by the time we reach to the declaration of financial results, our situation will entirely be different. Because earlier what we were doing, we were not aware, we were waiting for the accounts department to report. So we were very happy, we were feeling very relaxed that, see, my sales is increasing, my targets are being achieved. So of course my production department is doing well, it is having proper supply to the customers. So I am going to book a very good amount of profit. But somehow we were acting innocent on account of operating expenses, or what you call as indirect expenses, which have eventually eliminated your gross profit to a greater extent. So here in operating expenses structure, this is basically our query. These are the subsets of queries which we have from operating expenses structure when we conduct the operational analysis, or you can say analysis of operations. Third one is working capital management. This we have already studied in the subject of financial management, but here in analytics also we have a different perspective about this aspect of our operations, that is working capital management. We all know that working capital is basically the difference between current asset and current liability. We know about operating cycles, we know about management of cash, management of receivables, inventory management. But here what we do, we try to find out in what way the cash is being managed, whether the company is having requisite amount of cash or not, or there is some idle cash which is being kept. So on real time basis, once we have the reporting, we can invest that cash in some other profitable ventures, and by that we can generate some revenue. So this is the beauty of analytics, that on real time basis we are having a report, and we can ensure that there are no lapses, on account of your profitability, on account of your operating cycle, on account of your management of cash. So this is what we have into this operational analysis when we talk about financial analytics. So to sum it up, I would say that we have certain queries from operational analysis, and the best part is that on real time basis we are able to conduct this kind of analysis. And the techniques which we are using in financial analytics is basically the same what we have been using in our routine financial analysis, but the perspective is different from two perspectives. The perspective is different from two broad dimensions. One is earlier we were exercising it on the limited data, now we are doing it on a broad set of data, big data what you call. And second is we are doing it on real time basis. Earlier we were doing it as a kind of post-mortem. Once the financial results are out, we are conducting trend analysis, we are conducting vertical analysis, horizontal analysis, multi-dimensional analysis, analysis of cash flow, ratio analysis, but we were not doing it on real time basis. But the best part of analytics is that we are doing it on a real time basis. Now the widely used tool for analysis here is regression analysis, factor analysis, cohort analysis, cluster analysis, time series analysis, and sentiment analysis. Sentiment analysis is something which is increasingly used nowadays. That what is the sentiment of our customer, where we look at the polarity, that how many people are in favor of our product or our company and how many people are not in favor of our company. We can find the role of a specific strategy, whether the pricing is having a positive role or the company's performance is company's CSR activities have a positive role, or the company's image is having a positive role. You must have come across different news that due to this specific news in the market, the price of the shares of this company have increased, they have shot up, they have gone up. And due to a negative news, the public sentiment went against that company and the prices of the shares have gone down. So if we conduct this kind of analysis, we are aware that if I am going to take this step, this can be the possible outcome. So consequences are known to us, and once we know the consequences, knowing something in advance will let us manage that particular problem. It will not emerge as a crisis for our company. Whereas earlier what we were doing, we were analyzing after the crisis has come and we were somehow losing our capital. Capital used to be called as capital has gone watered and all, but here it is not so. With the help of analytics, we can save the hard-earned money of our shareholders who have invested their not only capital, their faith into your company, and you can save their interest also. So conclusively, if you ask me, I would say that financial analysis is mainly concerned with the ratios, whereas the analytics is a process which encompasses operational information and the way it is reflecting into the financial statements. And of course, at the end, we do compare the ratios between the companies, whether it is vertical analysis or it is horizontal analysis or it is a multi-dimensional analysis, but we do this kind of exercise into our analytics. So my dear learners, in this lecture my motive was to tell you what we have been doing in financial analysis and in what way this financial analytics differs. And the crux of the story is that now we are no more relying on the data only which is provided by the company, which is reported by the accounts department at the end of the financial year. We are starting simultaneously. We have a parallel kind of analysis. Our business is going on, and likewise this analytics is also functional, and we get meaningful insights from the data. So our data is telling us. So on real time basis, we have the reporting of the financial health of our company, and we can take corrective steps. We can formulate, implement proper strategies which are basically not based on intuitions, but based on what? Based on meaningful insights, the factual data, and that is what is the beauty of financial analytics. I hope you must have understood the basic difference between financial analysis and analytics with this lecture of mine. Thank you so much.